Dear students, in the present lecture, we are going to learn types of ESOP shares, over subscription and under subscription. I am Dr. V.K. Sawant. Shares can be issued at a par, shares can be issued at a premium, and shares can be issued at a discount. Share capital is divided into a smaller units called as shares. ESOP shares at par means a share of rupees 10 is issued for rupees 10. Another example, a share of rupees 50 is issued for rupees 50. In this case, no question arises about premium or discount. Most of companies raising capital from the open public by applying it means called as ESOP shares. Now we are concerned with ESOP shares at premium. A public limited company can issue its shares for a price more that their face value is known as ESOP shares at premium. The excess price over face value is called as premium. Those company having good reputation in the market, those company who having good goodwill in the market, they can issue their shares at premium. For example, if a share of rupees 50 is issued at rupees 60, here the difference between issue price and face value is rupees 10. So rupees 10 per share is a premium in this example. This is presented as under. Here issue price is rupees 60 per share, but the actual face value of that share is rupees 50. It means that a share of rupees 50 is issued for rupees 60. So here extra rupees 10 is termed as premium. The share premium account must be credited while passing the entry for allotment in which the amount of premium is included. In installment system, the price of a share is collected in number of installments, say application, allotment, first call and final call. Instead of collecting price in lump sum, number of installments are allowed. So suppose the shares are issued at premium and the amount of premium is included in second stage called as allotment stage. So how entries are to be recorded about the allotment when the amount of share premium is included in allotment. If the amount of share premium is included in allotment money, then the entries for allotment will be. Now we are concerned with two entries. One entry is related with allotment money due and another entry is related with allotment money received. If allotment money falls due, suppose we are taking here a date 1st March 2020. In this case, the entry of allotment money due is to be recorded as, in date column, date will be recorded 1st March 2020. When allotment money falls due, share allotment account debit. Then there are two portions. One portion is capital portion and another portion is premium portion. These two portions will be credited. Therefore, to share capital account, to share premium account, narration for this entry is being share allotment money due including premium. When allotment money received, for that purpose, this entry will be passed. There are 5 columns we have prepared here. First column is date, another column is particulars, third one is ledger folio, fourth debit rupees, and fifth credit rupees. When allotment money received, entry for it. In date column, we are going to record 1st March 2020 bank account debit. What amount received will be debited to share allotment account. Here share allotment account will be credited, but in first entry share allotment account is debited. Narration being allotment money received with premium. It is noticed that the amount of share premium is to be shown under reserve and surplus in the balance sheet. Balance sheet, there are two sides of balance sheet. First side known as capital and liabilities, and another side is asset side. Amount of share premium is to be recorded in balance sheet under the head reserve and surplus. Share premium being a capital profit. Amount received on account of share premium is termed as capital profit, and this profit is not available for distribution of dividend. Share premium can be used by the company as laid down under section 52 of the Companies Act 2013 for issue of bonus shares. Share premium can be used for issue of bonus shares. Share premium can be used for writing of preliminary expenses. Preliminary expenses are initial expenses. It means that preliminary expenses are incurred at the foundation stage or establishment stage of a company that can be write off after a particular period of time. Share premium can be also used for writing of underwriting commission paid or discount allowed on issue of shares or debentures. It is noted that discount amount at the time of issue of shares or debenture can be write off from the share premium. Share premium can be also used for providing premium payable on redeemable preference shares or debentures on their redemption. It means that for redemption of preference shares, for redemption of debentures, when a company is going to allow premium, that premium can be provided from the existing share premium account. It means that we can utilize share premium account by four ways. But court permission is essential for utilization of share for any other purpose. Instead of above mentioned four factors, we want to utilize that amount for another purpose. For that, the court sanction must be essential. Now we are concerned with issue of shares at a discount. Another part, second part, issue of shares at discount. Discounts means offering shares below than face value. Shares are said to be issued at a discount when they are issued at a price lower than the face value. The excess of face value over the issue price is called as amount of discount. In other words, shares can be issued for value less than their face value called as issue of shares at discount. For your information, I am putting here one example for understanding what discount means. For example, suppose Modern Company Limited issued 50,000 shares of rupees 20. Here the face value of each share is rupees 20. So a share of rupees 20 each is issued at rupees 18 each. Here the amount of discount per share is 2. It is presented in the following manner. It means we are prepared here three parts. First part is named as face value, another part is called as issue price, and last part is discount. Here face value per share is rupees 20, but actually this share is issued in the market at rupees 18 per share. It means the difference between face value and issue price is rupees 2, that is termed as discount per share. Therefore, a share having face value rupees 20 issued in the market for 18, so discount per share is rupees 12 is rupees 2. So discount means the difference between face value and issue price. When face value is higher than issue price, in that case, difference between face value and issue price is termed as discount. The discount on issue of shares must be treated as a capital loss and must be debited to a separate account called as discount on issue of shares account. When a company issued its shares in the open market at a discount, that discount is a capital loss, and for that purpose a separate account maintained called as discount on issue of shares account. However, the Companies Act 2013 has laid down certain restrictions for the purpose of issue of shares at a discount. These restrictions are as under: the shares must belong to a class already issued. Another restriction is that the issue must be authorized by an ordinary resolution of the company. The sanction of the CLB means company law board must be obtained at least 1 year must have elapsed since the date on which the company was entitled to commence business. These are the restriction, and that this restriction should be followed at the time of issue of shares at discount. The resolution must specify the rate of discount. It is noticed that the rate of discount should not be exceeding 10% of the face value. The shares must be issued within 2 months from the date of sanction by the company law board. These are the restrictions that should be followed by a company while issuing its shares in open market at discount. I am putting one example for your information here. If the shares are issued at discount and allotment money becomes due on 1st January 2020, since the discount is allowed on allotment, then accounting entry will appear as under. For passing any general entry, we are going to prepare 5 columns. First column is date, another is particulars, third one is LF, fourth debit rupees, and last credit rupees. When allotment money falls due and allotment money subject to discount, for that purpose entry will be passed as under. We are mentioning here date 1st January 2020. Share allotment account debit. When amount of allotment falls due, share allotment account will be debited. If there is discount, therefore discount on issue of shares account will be debited and share capital account will be credited. Being allotment money due subject to discount. While preparing financial statements like profit and loss account and the balance sheet at the end of each year, generally these financial statements are very important in relation to stakeholders. These important financial statements are profit and loss account and balance sheet. Discount on issue of shares should be recorded in these statements as under. It means discount on issue of shares we are going to record in two places or in two statements. That is first statement profit and loss account. That is also called as income statement. The reasonable amount of discount on issue of shares written off out of total discount is charged to profit and loss account. Suppose total amount of discount is rupees 1 lakh and in the current year we have write off rupees 10,000. That rupees 10,000 should be recorded to the debit side of the profit and loss account and termed as discount on issue of shares written off. The remaining balance, that is unwritten amount, in the above example, out of 1 lakh rupees 10,000 written off, recorded rupees 10,000 to the debit side of the profit and loss account. Here remaining amount is rupees 90,000. That is called as remaining amount or unwritten amount on discount on issue of shares is shown on the asset side of the balance sheet under the heading miscellaneous expenditure and losses. It means there are three methods of issuing of shares: issue of shares at a par, issue of shares at a premium, issue of shares at discount. Now another part of this unit is under subscription. A public subscription is invited by the company, but what desired us is not actual happening. There, therefore, a issue may be undersubscribed or oversubscribed. Now we are related with what is meant by undersubscription. When the number of shares applied from the public is less than number of shares issued or offered by the company is called as undersubscription. It means that the demand is less than the actual shares issued. In the other words, if a company receives application from the public for less number of shares than that issued by the company for subscription, it is called as undersubscription. In simple language, when the number of subscriber shares are less than issued share, it is called as undersubscription. It means we are not able to collect desired amount because demand received is less than the number of shares issued by the company. In such a case, company generally allots all the shares to the public. This is very important. Here we are allotting all shares to those who have applied for. Therefore, question of refund of application money does not arise. It means while recording journal entries, consider subscribed number of shares instead of issued shares. While passing entry in case of under subscription, we are going to consider only subscribed shares instead of issued shares. For example, suppose Ria Company Limited issued 2 lakh shares at rupees 10 each, but applications received for 1 lakh 50,000 shares from the open public. This is a case of under subscription. It means here we are ready to issue 2 lakh shares, but demand is less. Therefore, what actually demand received to the company, that may be considered for recording all entries as related to issue of shares. Then, on the contrary, there may be oversubscription. It is completely opposite of undersubscription. When the number of shares applied from the public is more than the number of shares issued or offered by the company is called as oversubscription. Oversubscription means more demand to our shares as compared to issued shares by the company. In another words, if a company receives applications more number of shares than the issued by the company for subscription, it is called as oversubscription. In very simple language, when public subscription is more than issued shares, it is treated as oversubscription. In such a case, it is not possible to consider all applications received. Therefore, the excess application money is either refunded or adjusted against allotment or next calls due. It means while recording journal entries, consider number of shares issued instead of subscriber shares, except first entry. In first entry, we are going to record all money received on account of application. Otherwise, remaining entries we are going to record as number of shares issued instead of subscriber shares. For example, suppose Priya Company Limited issued 1,50,000 shares at rupees 100 each, but applications received for 2 lakh shares from open public. This is a case of oversubscription. It means we are going to issue 1,50,000 shares, but actual applications were received for 2 lakh shares. Here we are not able, or company is not able to issue shares more than it declaration. Therefore, is oversubscriptions is a case when we are not able to fulfill the demand made by the public because of legal restrictions on the company. Therefore, a public limited company issue its shares in the market. The issue may be oversubscribed or may not be oversubscribed. It is noted that the exact applications cannot be received to the company. There should be either oversubscription or undersubscription. Therefore, in the present part, we learned about methods of issue of shares. These are the three methods, namely as issue of shares at par, issue of shares at a premium, and issue of shares at discount. The market conditions are not remaining same. The market conditions are fluctuating. Therefore, by considering our capital need, market conditions, and reputation of company, a company may decide in what type the company is ready to issue its shares. It may be issued at a par. It may be during the depreciation period. It may be issued at discount, and during the during the inflection period, or when a company got a good name in the market, that company may issue their shares at premium. And another part of the presentation is oversubscription and undersubscription. Oversubscription is nothing but more demand than issued by the company. It means in that case we are not able to fulfill the demands. We are restricted as issued shares only. So there are two ways of adjusting excess application money. The excess application money either uh, refunded or adjusted against allotment or calls money. In case of undersubscription, the demand received from the public is less than the shares issued by the company. Therefore, here we are considering uh, subscriber capital for passing of journal entries instead of issued capital, and we are giving shares, our company is ready to giving shares to all the persons who have applied towards the company. In this way, I am concluding my presentation here. I I am thankful to all of us